All right, so today I wanted to make a video on when to buy a company. I think there's two main mistakes that people make when it comes to, just general investing. Number one, people just buy bad companies, whether they're losing money, perpetually issuing shares, they're not overly profitable, don't have a moat, like you name your list of reasons to, or list of things to describe a bad company, right? Um, that's probably the main mistake people make is just not buying good companies. Because at the end of the day, good companies, fundamentally good companies, will go up at some point as long as the fundamentals stay good, right? That is something that is inevitable. Just a matter of when. Again, the other problem people make, and the problem I wanted to get into here, is how do you know if it's a good time to buy, right? Because just because a company is a good company doesn't necessarily mean you should buy it right now, because it may be expensive, right? Um, Tesla is a good example of this. Good company, but I think that, and objectively, I think it's pretty hard to argue that it's not expensive, right? You take a company like McDonald's, again, very different company than a company like Tesla. Again, very good company, but I would argue that it is expensive right now. And again, if we get right into it here, and we simply look at its metrics, again, this is McDonald's. Again, let's go back. Let's just go back 5 years. I think you should go back at least 5 years to get a good um, picture of things here. And again, this is the operating cash flow, or price to operating cash flow, price to free cash flow here. Um, and again, if we look at McDonald's here, the first thing we notice is, okay, it's currently at 25, or sorry, that's operating cash flow. Free cash flow currently at 34.33, highest it's ever been during that time, 47, low 17.79, average 31.76. So it's a decent amount above its average, right? So the first thing I would point out is you for sure do not want to buy a company. Well, not necessarily for sure, because if it's growing faster than what it previously was, then it may not be the worst idea in the world. But if you're not in a rush to get into things, and I would recommend to not be in a rush to get into companies, you want to buy companies below its average, assuming that the other metrics still make sense. Because let's just say that just because a company's cheap relative to its past doesn't necessarily make it good, because there could be, like, the fundamentals could be getting worse. Maybe there's other things going on, you name it. But there could be other reasons that a company is cheap. So this is another thing that I would point out. It's that, let's just say, you can get McDonald's at a 18 price to free cash flow. Well, if the profitability is going way down, right, or there's some massive scandal involving the company, or whatever, you name it, right, you probably don't want to buy it. But let's just say it gets down to 18, or 20, and all the metrics, the fundamentals still look good, then yeah, it's going to be a good time to buy. So um, if we get right into it here, if we go back, let's just go back, this 5 years. If you look at McDonald's, usually when it goes below 30, that's a good time. But specifically, I would say once it gets down to about 25, we can see this happened as recently as June, May, will that be March, and then again later in 2021, it was down there. Obviously, in the spring of 2020. So again, when I'm looking at McDonald's, I would want to get it below 25, right? And if we look at 25, well, what we would do simply is, okay, well, the latest is 34, right? So let's just go pull up our calculator here. 25 divided by 34, that's, about 26% cheaper than where it is right now. So if we go back to McDonald's and we pull up its existing price, let's just round up to 272. and we go, all we have to do is just times this by 272. We're looking at 200, right? So in my opinion, a fair price to pay for a McDonald's right now, or at least a good price, maybe not necessarily a fair price because fair is not an objective term. In my opinion, a good price to buy McDonald's at right now is around $200, right? So it's quite a bit higher than that. It's at 271, 272. So again, what I would do personally is simply set a notification that if McDonald's hits that number, you get a notification. You look into things because again, you want to look and see if anything has changed between now and then, right? Have it like I mean, go into their numbers, right? Has you know revenue, projected revenue gone way down, right? Have they taken on a whole bunch of debts, right? Is profit going way down, right? There's a laundry list of reasons that a company might be cheap and for good reason, right? So that's what I would do simply is, and to sum it up here, nobody can know for sure whether or not a company or what the future price action of a company is going to be. Nobody can know that, right? Especially in the short term, right? Because 10 years from now, I would say there's a 99% chance that McDonald's is going to go up, right? But in the next month, in the next 6 months, in the next year, anything could happen, right? Anything could happen. So we cannot know for sure the price action in the short to medium term of any company, of any index, it doesn't matter. What we can know for sure is whether or not a company is cheap or expensive, right? And you can do this with pretty much any asset. Stocks, it's easier in my opinion, but you can do this with any asset, right? And a key aspect of good investors is they don't overpay for good businesses, right? I mean, this is something that again, virtually every good investor will bring up, right? Just because a company is good doesn't necessarily mean you should buy it right now, right? You want to make sure you get it for a fair price, right? Because at the end of the day, that's what's important. And again, you want to keep an eye on this kind of stuff, right? Too. Maybe you say, hey, I want to buy McDonald's for a 25 price to free cash flow, preferably lower, but that's where I would be comfortable, right? You could even find a way to set a reminder for that, or you could do that kind of stuff, right? So that is the way to know. Like I say, to sum it up, we cannot know, like nobody can know for sure the future price action of any company, especially in the short to medium term. But we can tell for sure, is an asset cheap, expensive, fairly average price, fairly priced, whatever you want to say, right? If a company's at its average, that probably means that it's fairly priced, right? So technically McDonald's, if it was at a 31, that's about 10% lower than it is. So again, if McDonald's was at about, whatever that would be, 245 to 250, that's probably roughly where it should be. Again, if it's below that, it's probably underpriced. If it's above that, it's probably overpriced, right? And again, the way we know that is that this is what investors were willing to pay for it in the past. Now, technically, if earnings or revenue isn't necessarily the greatest reminder, but free cash flow, something like that, if they announce a massive dividend increase or a massive, a very good acquisition, whatever, that could cause another monkey wrench to be thrown into things. So there is other aspects to it. Obviously, I want to make that clear. But like I said, we can know for sure if a company is cheap or expensive. And that's the point I wanted to bring up. And that's when you know when to buy a company. In my opinion, that's one of the easiest ways to know just from the outside looking in. So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe and stay tuned for more.